Welcome back to Startup Accounting 101. It's a video series for founders to understand accounting fundamentals for running a business. So we're moving through the financial projections template, and this is available for free from score.org. Just go to their template gallery, download this file. I'll have their link in the description below. This video, we're covering tab 6A, which is the cash flow forecast for year 1. Now, the cash flow forecast or statements generally shows the cash impact over the year for a business. So it shows like the cash inflows and cash outflows of that business. I'm going to collapse down the months to only show the total. To compare against a more common presentation of the cash flow statement. So this is an example of a statement of cash flow where the sections are separated into operating activities, investing activities, and financing activities. So each of these sections have their own subtotal. Here they each have a subtotal with either the net cash provided or used in that particular activity. And typically the cash flow statement starts with net income, and there are adjustments for anything that have an impact on cash. So these are the different activities in operations that impact cash: capital expenditures, proceeds from issuing debt, so and then dividend payouts. And at the bottom there's a summary that has, here's the beginning cash balance, and then this is the ending cash balance, as well as the net increase or decrease of cash for the year based on the different activities for that year. So this is what a typical statement of cash flow looks like. That's adherence to GAAP, which is generally accepted accounting principles. So most of your accountants will actually build a cash flow that looks like this. Now the cash flow in this template, it's modified into a simpler layout. It separates out, the inflows and outflows into two distinct sections. And this is honestly an easier, sort of more intuitive way to visualize the cash flow for the business. And both methods should come to the same result. It should have the same sort of net cash flow, net cash difference. And then, of course, the beginning balance here, and then the ending balance. So both should come to the same sort of ending cash balance. So what I'll do is I'll expand this out. And here we see sort of a month over month trend of the cash flow for the business. So I'm going to review column B, which has different cash categories. So we're starting with the beginning balance. So this, for this business, this $30,000 essentially comes from the starting point and the working capital, which is here. So this is the amount of cash on hand that we're bringing into the business. And again, for me, I wanted that to cover roughly a month of payroll. It's about $30,000. So that sort of kicks off the business. This is how much cash we have. And then the cash inflows are the different sources of cash for the business. And there are two main sources. they all come from sales, but there are cash-based sales, and then there's accounts receivable. So from the additional inputs, the percentage of collections here, this drives the cash flow. So everything that is paid within the month, all cash, versus AR with net terms of net 30. And we see how that affects the cash flow here. So the cash sales paid right away, net 30 sales in January, we're not going to see the cash until the customer pays it 30 days later in February. So this is the cash from the sales that we made in January. So these two together give us the total cash inflow month over month here. And we're moving to the cash outflows. So these are basically all the cash expenditures. And here is where we have the breakdown for the different types of activities. So we have investing, operating, and financing activities. So within investing, there are three sort of main categories of investments for the template. One is buying more equipment, getting more fixed assets. That's driven from the additional fixed asset purchases. So whatever was completed here is going to get pushed out into the cash flow. So for me, it was just buying, more equipment in October. We'll skip that for just a second. So the cost of goods sold are basically all of the ingredients that go into the sales. So the cost of goods sold comes from the sales forecast. So here, all of the sales, the COGS is about, for the first month, is about $10,000. So this is coming here. And this, once you make the sale, you're not going to have these materials anymore. So as soon as somebody buys a candy bar, this the materials goes with the customer that's buying the item. Now, there are additional inventory of raw materials you can buy to keep on hand. So as soon as, let's say in February, when I finally get paid from some of my customers, I might have a little bit more cash on hand. And so I might want to buy some sugar, some chocolate, just to have it on hand. So we'll put that here. And this is to help smooth out operations and production. There could be supply chain issues, delivery issues, and you don't necessarily want those to impede your production. So if you've got customers that are expecting product, it might be wise to have more raw materials so that you can fulfill the PO, the purchase orders from your customers. So I comfortably want to have at least 1 month buffer, if not more. But right now we might not have enough cash to have that much. So I'm happy with 1 month here. And then here in October, we know that we're really ramping up production for October. So in September, I might get some more. So I might buy another $10,000 of raw materials just so that I have that on hand for production. And so these three are for the investing activities. Now moving on to the next sections, which is operating activities. So these come from the prior tabs that we completed. So operating expenses here, these are the total expenses for all of these operating expenses. So this is getting pulled into this line here, operating expenses, payroll, year one, that is here. Here's the total salary and related expenses. So your payroll expenditures per month, that's getting pushed into the cash flow statement. You're gonna have to pay your people, pay wages. Taxes. There's a note here that says this line allows you to approximate the personal income tax of the owners. This is the tax on the profit of the business. And so that is driven by this, the income tax assumptions. Again, I'm assuming that this is a C Corp, which is a 21% tax rate. And so this percentage is getting pushed through the cash flow here. And typically for taxes and estimated tax payments, it's usually made at the end of the quarter, which is why there's just one number at the end of every 3 months, because that's when you'll make the estimated tax payments. So these three constitute the operating activities for the business. And then we move into the financing activities for the business. Now, the loan payments, I believe this comes from Starting Point. So these are the different sources of funding kicking off the business. And so whatever is completed here with the loan rates and the terms is giving us a total monthly payment for these loan activities. And this number is going to the cash flow. So you're going to have to pay down your various loans here. Owner distribution, there's only record owner draws above those already listed on the payroll tabs. So this is any distribution as an owner. You can kind of take distributions from the business. The first year, as you're building up, inventory, as you're investing in the business, you may not have an opportunity to draw from to make an owner's draw or distribution. They're kind of synonymous here. So for me and my forecast, I'm not gonna project out any distributions for year one. Line of credit interest and repayments, I will no, maybe I will talk about that now. So here in additional payments, so I put down I want to keep $30,000 as a minimum cash balance for the business. So the impact of that is that the ending cash balance, I don't want it to dip below $30,000. So here, if we look at, the cash inflow is about 20,000. The cash outflow is about 60,000. So your net cash flow is about $40,000 loss. We're spending a lot more, we're building up the business. So yes, we're going to have a lot of expenses. And so we started out with 30,000. But the first month alone, we're already sort of under by 40,000, which gives us overall cash balance of we're under $13,000. So in order for us to get to that $30,000 buffer that we're comfortable with, we have to draw down. We have to a line of credit of $43,000. So we need to borrow $43,000 in order for us to get the $30,000 cash minimum. So here, every month, if we have to draw down, we're going to see it in this row here. This is the drawdown row. And so for every month we have to draw down, it's going to be here. The last row is the balance. So here we drew down, and so, we're adding to the balance. So this is like the ending balance of the debt that we owe to the bank. This is how much we owe. So here is calculating out the interest. And so here we said we have to pay about 8% in interest to the bank when we borrow from the bank in this line of credit. So that's what this interest is. If we have extra funding, extra cash on hand that we can start paying down this loan to the bank, we can put that here. Now, this is the cash balance line. So this is how much we have to work with, and it's pretty lean. Like, I wouldn't be comfortable paying it down until we have a good margin. So here we're starting to slowly build up our cash in the bank. So let's say I want to pay down $2,500 here. And then November, again, after the huge spike in sales in October, we finally get a nice chunk of cash coming in November. So I'm going to say, and this is the balance that we still owe to the bank, I'm going to pay down maybe $20,000 here. So when we pay $20,000, the amount owed to the bank goes down. Our cash balance, of course, goes down as well. And then we still have a good amount of cash left in December. So I'm going to pay maybe $15,000. And at the end of the year, we see that we have still a good amount of cash in the bank. Our line of credit is about, $12,000. Our ending cash is going to keep increasing as the business grows. We're going to have more cash needs on hand. So this is like the payroll growth projection. In year 1, every month it's about $30,000. In year 2, as we're growing, it's about $50,000. So at the end of the year, I'm going to say I want to keep, about $50,000. So this, we basically completed the cash flow for year 1. We're seeing, as we're moving through the year, as we're making more sales, we're seeing how all of these sales, all of these expenses that we have to pay for, how it's actually affecting the overall cash flow throughout the year, ending in December. So this is the ending balance, and then the totals is how much we're getting from every activity. So sales coming in here, we have, and then all of our expenditures here. So here we go. We've completed the cash flow for year 1. The next video, we're looking at projecting the cash flow for years 1 to 3. So the forecast for the next couple of years. Like and comment if you enjoyed the video. Please subscribe, and thanks for watching the video.